This video focuses on an overview of the statement of cash flows, which reports the cash receipts, cash payments, and net change in cash for a period of time. This statement explains how the amount of cash at the beginning of the period became the amount of cash reported at the end of the period. So it explains the change in cash for a period of time. The statement of cash flows reports cash inflows and outflows in three broad categories: operating, investing, and financing activities. The operating activities section focuses on the company's ability to generate cash through operations. So typical inflows are from the sale of goods or services, and typical outflows are to suppliers and employees. Many believe this section is the most important because it's the best measure of a company's ability to continue. In essence, does the company generate sufficient cash? We look at this section to determine if the company has enough cash to run its day-to-day operations.
Companies classify as operating activities some cash flows related to investing and financing activities. For example, receipts of investment revenue, such as interest and dividends, are classified as operating activities. So are payments of interest to lenders. Why are these considered operating activities? Because companies report these items in the income statement where the results of operations are shown. Let's take a look at our investing activities. When it comes to this classification, I want you to think of the inflows as well as the outflows to come from either the sale or purchase of property, plant, and equipment, as well as investments, and also if a company is making or collecting loans to other entities. Right, the last thing we have to talk about are the financing activities. When it comes to these activities, I want you to think of the inflows as any cash that's received from the issuance of common stock or debt, such as bonds and notes. And as far as the outflows, I want you to think of any payments that are made to the stockholders as in the form of dividends, or any payments that are made to retire long-term debt or reacquire capital stock. Not all of a company's significant activities involve cash. Examples of significant non-cash activities are the issuance of common stock to purchase assets, converting bonds into common stock, issuing debt to purchase assets, and lastly, exchanging plant assets. Companies do not report in the body of the statement of cash flows significant financing and investing activities that do not affect cash. They will report these activities in either a separate schedule at the bottom of the statement of cash flows or in a separate note. The cash flows from operating activities section always appears first, followed by the investing activities section, and then the financing activities section. The sum of the operating, investing, and financing activities sections equals the net increase or decrease in cash for the period. This amount is added to the beginning cash balance to arrive at the ending cash balance, the same amount that is reported on the balance sheet. Any significant non-cash financing and investing activities will be reported at the bottom of the statement of cash flows or in a separate note.